Let me tell you about the worst financial decision I ever made. It wasn't a bad stock pick. It wasn't a failed business venture. It wasn't poor timing, bad luck, or a market crash I didn't see coming. It was a decision I made while sitting in front of a perfectly good trade. A trade that was working exactly the way I planned. Staring at a screen and refusing to do the one thing that would have protected everything I had built. I didn't exit. The position was up, my original target had been hit, everything in my plan said, take the money, protect the gain, walk away. But something else was talking louder than my plan. It was the voice that every trader and investor knows, the one that says, just a little more, it's going higher. You've come this far. Don't leave now. I listened to that voice. The market reversed, the profit evaporated, and then the loss began. And I still didn't exit, because now I was waiting to get back to break even. By the time I finally left that trade, I had turned a meaningful gain into a significant loss. And here's the part of this story that should have taught me everything, but took me years to fully understand. My entry had been perfect. My analysis was correct. My timing was right. The trade worked exactly as I said it would. The only thing that went wrong was my exit. And the exit, not the entry, was what defined my result. That experience, repeated in different forms across the early years of my investing life, eventually led me to the single most important realization I have ever had about money, markets, and building wealth. The entry gets you in the door, but the exit determines whether you walk out richer, poor, or with nothing at all. And in the next 45 minutes, I want to show you exactly what I mean. When I first started investing, my entire world revolved around entry. Charts, indicators, patterns, RSI, MACD, moving averages. Every signal I could find, every tool I could learn, every piece of analysis I could run. I was hunting for the perfect moment to get in the exact price, the exact setup. I thought that if I could just crack the code on entry, if I could identify the precise moment when a stock was about to move, I would have solved the puzzle of the market. I was wrong. And I was wrong in the most expensive way possible. Because the more I refined my entries, the more I assumed that the hard work was done the moment I clicked buy. I would find a great setup, I would enter at what looked like an ideal price. And then I would sit back and wait for the market to reward my analysis. Sometimes it did, sometimes it didn't. But the real problem, the one I didn't see for years, was that my returns had almost nothing to do with how good my entries were. They had everything to do with what I did after the entry. Here is what I eventually understood. Entry is an event. It happens once in a single moment. You press a button, the position is open, and that's it. The entry is done. It cannot be changed, improved, or optimized once it's in. But exit is a process, a decision that unfolds over time, a test of your discipline, your psychology, your plan, and your ability to remain rational in the middle of a market that is designed, at least it can feel this way, to make you irrational. And here is the most important part. Any entry, good, bad, or mediocre, can become profitable with a good exit. Any entry, no matter how brilliant, can become a disaster with a bad one. I've seen extraordinary entry setups produce devastating losses because the person holding the position could not bring themselves to exit when the trade went wrong. I've seen ordinary, unremarkable entries produce exceptional returns because the person had the discipline to hold through temporary volatility and exit only when their original thesis was complete. Entry is a starting point. Exit is the destination. And yet we spend most of our time and most of our education on the starting point, and almost none on where we actually end up. The reason for this is not stupidity, it's psychology. Entry is exciting. It comes with energy, optimism, hope. When you enter a trade or an investment, you are in the best possible emotional state. You believe in the thesis. You've done the research. The future looks promising. Entry feels like a beginning, and beginnings always feel good. Exit, on the other hand, is almost never comfortable. If you're exiting at a loss, you're being forced to admit you were wrong. You're watching money leave your account. You're confronting the gap between what you expected and what the market delivered. And if you're exiting at a profit, there is always the nagging voice asking if you're leaving too early, if you should wait just a little longer, if the next move will be even bigger than the one you're about to lock in. Both scenarios are psychologically difficult, and difficulty, especially financial difficulty, makes us avoid the thing we need to do. So we delay, we rationalize, we tell ourselves stories about why the exit we planned is not the right exit for this particular situation. And the market, which has no interest in our stories, keeps moving. I spent years working through this pattern, recognizing it in myself, understanding why my brain resisted the very decisions my plan was telling me to make. And what I discovered, slowly, painfully, through real money and real lessons, is that exit discipline is not a technical skill. It is a psychological one. And mastering it requires understanding, not just the market, but yourself. Let me introduce you to your real competition in the market. It's not the institutional investor with 20 analysts in a Bloomberg terminal. It's not the algorithm firing 1,000 trades per second. It's not the hedge fund manager with 20 years of experience. Your real competition, the entity most likely to cost you money, is the person looking back at you in the mirror every morning. I say this not to be discouraging, but to be honest. Because until you understand the ways your own mind works against you in a market environment, you will keep repeating the same mistakes regardless of how much market knowledge you accumulate. The exit is where this becomes most visible. When a trade is going well, ego says, "I knew it, I was right. My analysis was brilliant. This is going to be even bigger, I should hold." And sometimes, holding is the right call, but often, when ego is driving the decision rather than the plan, you end up holding past the point where your thesis was already proven, deep into territory where you're now simply hoping. And hope, as I eventually learned, is not a strategy. When a trade is going badly, ego operates differently. Now it refuses to exit because exiting means admitting you were wrong. And the ego, in its most primal function, exists to protect your sense of self, to maintain the narrative that you are competent, intelligent, capable of reading the market. Exiting a losing trade destroys that narrative for a moment. It says, this particular decision did not work. The market moved differently than you expected. And ego cannot tolerate that. So it invents reasons to stay. It's just a temporary pullback. It will reverse, the fundamentals are still intact. I just need to wait. And sometimes those reasons are even partially correct. But the problem is that you can't tell the difference between a genuine reason to hold and an ego-driven excuse to avoid the pain of being wrong, because both feel identical from the inside. This is the central psychological challenge of exit. Not picking the right price, not timing the market perfectly, not calculating the precise moment when a trend is exhausted. The challenge is overcoming the part of your mind that would rather protect your self-image than protect your capital. I want to tell you about a pattern I observed in myself, because I suspect you will recognize it. In the early years, I would enter a trade with a clear plan A, defined stop-loss level, a target exit price, a thesis I had thought through carefully. And then the trade would open. And the moment the market began to move against me, even slightly, everything I had planned would begin to feel uncertain. Not because the thesis had changed, but because the market was disagreeing with me in real time. And real-time disagreement feels very different from theoretical risk when it's your money on the line. I would watch the position move toward my stop loss. And instead of letting my plan execute, instead of trusting the decision I had made when I was calm, rational, and unemotional, I would begin to negotiate with myself. Maybe I set the stop loss too tight. Maybe I should give it a little more room. This is just a shakeout. The big players are washing out the weak hands before the real move. I know this stock, I've done the research, the market is wrong, not me. And then I would move the stop or remove it entirely. And I would convert what was supposed to be a defined, manageable loss into an open-ended position where I was now hoping my way to a recovery. Sometimes the market reversed, and I felt vindicated. I would tell myself, I was right to be patient. I was right not to stop out. And those moments of accidental vindication were the most dangerous outcomes of all, because they reinforced exactly the wrong lesson. They taught me that overriding my plan worked. And the next time I needed the discipline to exit cleanly, I had one more story in my head about the time I held and won, until the time I held and didn't win. And the loss that could have been $1,000 became $10,000. This is how accounts get destroyed. Not in one catastrophic trade, but in 100 small violations of a plan, each one justified in the moment, each one eroding the discipline that separates the trader who survives from the one who doesn't. What changed for me, what finally broke this cycle, was not better analysis. It was a different definition of success. I stopped measuring the success of a trade by whether it made money. I started measuring it by whether I followed my plan. This sounds simple. It is not. Because it requires accepting that a trade can be a financial loss and still be a good trade, if you executed your exit exactly as planned. And it requires accepting that a trade can be a financial gain and still be a bad trade, if you got there by abandoning your rules and getting lucky. The market rewards consistency, not genius. And consistency requires a different scorecard than the one most people keep. When you redefine success as plan execution rather than profit, something remarkable happens. The fear of being wrong, which drives so many bad exit decisions, begins to loosen its grip. Because being wrong about a trade is no longer a failure. It's a data point. It's the cost of doing business in a probabilistic environment. And you can accept a cost much more easily than you can accept a failure. That single shift in perspective changed my trading more than any technical knowledge I have ever acquired.
Once I understood the psychological dimensions of exit, once I stopped pretending it was purely a technical problem and accepted it as a behavioral one, I began to build a different kind of framework. Not a more complex one, a more honest one. The foundation of everything I do now starts with a single rule that I treat as non-negotiable. Never enter a position without knowing exactly how you will exit it. This sounds obvious. Most traders would say they follow it. Most of them don't. Not really. Because knowing how you will exit a position means something very specific. It means you have defined in advance, not in your head, but in writing, two things. First, the price at which you will admit the thesis is wrong and exit to protect capital. Second, the price or condition at which your thesis is complete and you will exit to capture the gain. Both of these must be defined before you enter, not adjusted after,
not reconsidered based on how you're feeling about the market that day. Defined, committed to, written down. The reason writing matters is not ceremonial, it is psychological. When your exit plan is in your head, your mind has enormous creative latitude to reinterpret it in the moment. The stop loss that was at $50 becomes, well, 48 is basically the same. The target that was at 75 becomes, maybe I should hold for 80. When your exit plan is in writing, specific numbers, specific conditions, the latitude disappears. The plan is the plan, and deviating from it requires an active, deliberate choice to override something you committed to when you were thinking clearly. That friction, small as it seems, makes an enormous difference in behavior over time. Let me break down the two sides of exit: loss exits and profit exits, because they require different thinking and they create different psychological challenges. Loss exits first. A loss exit, a stop loss, exists for one purpose and one purpose only: to prevent a small, manageable mistake from becoming a large, account-threatening one. I learned this lesson the hard way. The way most people learn it, I let a small loss become a large one, because I couldn't bring myself to accept that I was wrong. I hoped, I told myself stories, and the market did what markets do. It kept moving in the direction that was wrong for me. The rule I eventually built, and I've never broken since, is this: never let a small loss become a big loss. Whatever your defined stop loss is, execute it. Every time, without exception. I know what you're thinking, but sometimes the market comes back. And you're right. Sometimes it does. I have exited positions at a stop loss, only to watch the stock reverse and move exactly where I thought it would go. That is painful. There is no denying it. But here is the calculation I want you to make honestly. For every time the market came back after you held through your stop loss, how many times did it not? How many times did you hold through your stop, then hold some more, then hold a little longer, until what started as a small mistake became something that genuinely hurt your account? The math, when you're honest about it, almost always favors the disciplined stop. Because even when you're wrong to exit, even when the market reverses after you got out, the loss is defined. It's over. You know exactly what it cost you. When you remove the stop and hold, you have converted a known finite cost into an open-ended risk. An open-ended risk in the market always finds a way to surprise you. I once heard a trading mentor say something that stuck with me permanently. The market can stay irrational longer than you can stay solvent. If you hold through your stop loss because you're sure you're right and the market is wrong, you may eventually be vindicated, but you may run out of capital or emotional resilience, or both, long before that vindication arrives. The stop loss protects your ability to stay in the game, and staying in the game, surviving, is the prerequisite for everything else.
Now let's talk about profit exits, because these are at least equally important and far less discussed. The conventional wisdom says profit exits are easy. You're making money. What's hard about that? The answer is everything. Because profit creates its own version of the same psychological trap that loss creates. And the trap has a name. Just a little more. When a trade is working, when the market is moving in your direction, and the profit is growing, something happens to the human mind that is almost chemically similar to what happens with any other form of reward. You want more. Not because more is necessarily available. Not because the setup continues to justify the position. But because the experience of gaining feels good, and we are wired to want to extend experiences that feel good. This impulse, which feels like confidence and conviction, but is actually greed in disguise, is what causes people to watch their profits evaporate. They were up 30%, then 25, then 20, then 15 at every step.
The voice said, "It's just a temporary pullback. It's going higher, hold." Until they were back to flat or in a loss. And they could not understand how they had let a winning position turn into a defeat. The answer is always the same. They had a profit, but no plan for how to protect it. My own practice, developed over years of experience, is to define my profit exit the same way I define my stop loss. Specifically, in advance, in writing, before I enter the position. When price reaches my target, I exit. Not, I'll think about whether to exit. Not, I'll see how the market feels that day. I exit. Because that is what I decided when I was rational. And I do not trust my in-the-moment emotional state to make a better decision than my calm, pre-planned one. There is no such thing as a perfect exit, nobody. Not the most experienced investor in the world consistently sells at the absolute top. The attempt to do so is not sophistication, it is greed. The goal is not to capture every last cent of a move. The goal is to consistently capture a meaningful portion of the right moves, while consistently limiting the damage from the wrong ones. Consistency, not perfection, is what builds wealth over time.
Here is something I came to understand only after years in the market. Every exit, whether it's a stop loss that cuts a loss, a profit exit that captures a gain, or the moment you walk away from a position that isn't working the way you expected, is not primarily a financial event. It is a self-knowledge event. When you exit a losing trade cleanly, honoring your stop, accepting the small loss, moving on, what you have actually done is put your ego in its proper place. You have said, "My capital matters more than my need to be right." That takes more strength than most people realize. And every time you do it successfully, you build a kind of psychological muscle that makes the next decision slightly easier. When you exit a profitable trade at your target, resisting the temptation to hold for more, what you have actually done is put reason over impulse. You have said, "My plan is more reliable than my feelings in this moment." That too, build something confidence in your own system, trust in your own process. The knowledge that you do not need the market to validate you, that your plan, when followed, is validation enough. And conversely, when you violate your exit, when you move a stop, hold past your target, let a small loss become a large one, the market tells you something about yourself. It tells you where your discipline broke down, what specific emotion, fear, greed, hope, ego, was strong enough to override your plan. And that information, when you're willing to look at it honestly, is more valuable than any profit you might have made by playing it safe. I have a practice that I would recommend to every trader and investor, regardless of their level. After every exit, every single one, I write down 3 things. What did I plan to do? What did I actually do? And if those 2 things were different, why? Not to punish myself for deviations, but to understand them, to see the patterns, to know which emotions are most likely to interfere with which types of decisions. Because the market does not keep you from repeating mistakes. Only self-knowledge does. I want to talk about the relationship between exit and freedom. Because I think this is the piece that most people miss entirely when they think about trading and investing discipline. Most people think of a strict exit plan as a constraint, a set of rules that limits what they can do, a framework that removes flexibility. I came to see it as the opposite. When you have a clear, predefined exit strategy, when you know exactly what you will do if the trade works and exactly what you will do if it doesn't, something extraordinary happens. You stop being afraid. Not because the risk disappears. The risk is exactly the same. The market is exactly as unpredictable as it always was.
But the uncertainty, the open-ended, formless anxiety of not knowing what you'll do if things go wrong, that disappears. Because you've already answered the question. You've already decided what you'll do. The decision is made. And when you're in the middle of a volatile market, not having to make that decision under pressure is an enormous psychological gift. When the market falls sharply, the person without an exit plan is in crisis. They're making decisions in real time, under emotional pressure, with their financial well-being on the line. Every instinct, fight, flight, freeze, is competing for control. The person with a clear exit plan simply executes what they already decided. Not because they're emotionless. They feel everything, but their actions are not driven by their emotions. They are driven by their plan. That is the freedom an exit strategy gives you. Freedom from fear, freedom from indecision, freedom from the tyranny of real-time emotional decision-making. And paradoxically, this freedom is what allows you to hold positions longer when holding is the right call. Because you know your downside is defined. You know that the market can move against you only so far before your exit kicks in and limits the damage. The safety net is what allows you to walk the tightrope.
I want to shift from the exit decisions and individual trades to something larger. The exit mentality applied to your overall approach to investing. Because the same principles that govern when to exit a trade also govern something more fundamental: when to do nothing at all. Early in my investment career, I believed that returns were generated by activity. That the more analysis I did, the more positions I took, the more I engaged with the market, the better my results would be. The market taught me otherwise, and the lesson was expensive. I once sold a position after a 20% gain because I was excited about it. Because I wanted to lock in the profit and take my victory lap. It felt like discipline in the moment. It felt like I was executing a good exit. Several months later, that position had grown to more than 4 times my original investment. The exit had been right according to my short-term thinking. But I had missed the most powerful part of the move because I had confused busyness with strategy. That experience began a shift in how I thought about holding, about the relationship between patience and return. I started to understand that waiting is not passive. Waiting, when it is the correct action, when you have a strong position in a fundamentally sound business and the thesis is still intact, is one of the most actively disciplined things you can do. Because the market will constantly give you reasons to exit. Every dip will feel like the beginning of a crash. Every piece of negative news will feel like a warning to get out. Every time someone else sells, part of your brain will ask if they know something you don't. Resisting those pressures, staying calm while the market makes noise, is work, real, difficult, emotionally demanding work. It just doesn't look like work from the outside. I want to talk about 2008. Because the 2008 financial crisis is the event that more than any other clarified my thinking about patience, holding, and the discipline of staying when everyone else is leaving. When the global financial crisis hit, when banks were collapsing and markets were in free fall, and every financial headline seemed designed to induce maximum panic, most investors did the understandable, reasonable, emotionally logical thing. They sold. They reduced exposure. They moved to safety. They waited for things to stabilize before they would consider going back in. I did something different. Not because I was braver than them. Not because I knew things they didn't. I did something different because I had learned to separate the market's short-term noise from the long-term question I actually care about as an investor. And the long-term question,
The only question that matters if you have a sufficiently long time horizon was this: are the fundamentally sound businesses I own still fundamentally sound? The answer, for the businesses I had selected carefully, was yes. The products they sold were still needed, the balance sheets, while under pressure, were not broken. The management teams were experienced, the long-term competitive positions were intact. The market was pricing these businesses as if they might not survive. But survival was not really the question. The question was whether they were worth owning at a price that reflected panic rather than value. And the answer was clearly yes. So I didn't sell in some cases. I added to positions at prices that, in retrospect, looked like extraordinary bargains. Not because I knew when the bottom would be. Nobody does. But because I was focused on value, not price, on the quality of the business, not the direction of the market. What happened in the years that followed is well documented. Markets recovered. The businesses I held came back stronger than before. But the more important lesson was not about returns. It was about discipline. In the middle of 2008, when every instinct, every headline, and every conversation said sell, get out, this is not over. The most important investment decision I could make was the decision not to act. The best exit in that period was the exit I didn't take.
This brings me to what I consider one of the most underrated principles in all of investing. What you don't do is sometimes more important than what you do. Not every opportunity is for you. Not every moving stock deserves your attention. Not every trend, hot sector, or exciting new narrative requires your participation. And the discipline to say no, to sit out when the right opportunity is not clearly in front of you, is not a failure of engagement. It is the practice of an intelligent investor. I have watched people destroy years of patient, careful wealth building in the space of months. Not because they made one catastrophic decision, but because they stopped being selective. Because every exciting story became a compelling enough reason to act. And the market, which never runs out of exciting stories, eventually found one they couldn't resist. One that cost them more than they could afford to lose. The discipline of not acting. Of waiting until the conditions are genuinely right. Until the valuation is reasonable. Until the thesis is clear. Is itself a form of exit discipline. You are exiting from the noise. From the impatience. From the anxiety of not participating. And that exit, the exit from impulsiveness, is often the most profitable move you never made.
Over the years, I developed a set of questions that I ask before every significant investment. Not every trade, but every position I intend to hold for a meaningful period of time. These questions are simple. They have never changed. And they have saved me from more bad decisions than any technical indicator I have ever learned. First question: do I understand what this business actually does? Not a superficial understanding, a genuine one. Can I explain in plain language how this company makes money, who its customers are, why those customers choose it over alternatives, and what would have to change for the business to stop working? If I cannot explain it clearly enough, that a non-expert would understand, then I don't know it well enough to own it. And things I don't understand can develop problems I don't recognize until it's too late. I have a personal rule that has served me extremely well. I never invest in something I cannot explain. Not because I think complexity is inherently bad, but because complexity that I don't understand creates a specific kind of risk. The risk of not knowing what you're watching for. And if you don't know what you're watching for,
You won't see the warning signs that tell you it's time to exit. Second question. Can I imagine this business being significantly larger in 10 years than it is today? This is not a prediction. I am not claiming to know the future, but I am asking whether the business has the characteristics, the market, the competitive position, the growth opportunity that makes a significantly larger future plausible. If I can't construct a reasonable path to 10-year growth, I'm not making an investment. I'm making a speculation. And speculations require a different framework, a shorter time horizon, a stricter exit plan, and a smaller position size. Third question. Do I trust the people running this business? Not like them. Not find them impressive. Trust them. This means, do I believe they are allocating capital thoughtfully with the long-term interests of the business and its owners in mind? Do I believe they are honest with shareholders about both the opportunities and the risks? Do I believe they would make the difficult decision when the difficult decision is needed? Management is the variable that is hardest to analyze from the outside, and the one that matters most in the long run. A mediocre business run brilliantly outperforms a brilliant business run mediocrely almost every time. And the fourth question, which underlies all the others. Am I comfortable holding this for 10 years? Not planning to comfortable with the idea, but because markets do unpredictable things. Businesses go through difficult periods. There will almost certainly be a point in the life of any long-term investment where it looks significantly worse than when you bought it. If I cannot imagine holding through that, if the position size is too large, the thesis too uncertain, or my own conviction too shallow, then I need to either adjust the position or find something I'm more confident in. These 4 questions are not a formula. They don't produce a number or a rating. What they produce is clarity, and clarity about what you own, why you own it, and when you will exit it is the rarest and most valuable thing in investing.
I want to close this section with something that took me a long time to genuinely believe. Not just intellectually accept, but believe in my behavior. Temperament matters more than intelligence. This sounds like false modesty, like the kind of thing someone says to make less analytical people feel better. It is not. It is one of the most empirically supported observations in the history of financial markets. The investors who have generated the greatest long-term returns across different markets, different eras, different strategies, consistently share one characteristic. And it is not IQ. It is not education. It is not access to better information. It is the ability to remain rational when the market is making everyone around them irrational. A calm mind makes better decisions than an anxious one, every time without exception. When the market is falling and you are panicking, your analytical capabilities are genuinely diminished. Your brain is in threat response mode. You are not doing your best thinking. You are looking for the exit. When the market is rising and you are euphoric, your risk assessment is genuinely compromised. You are underweighting the possibility of loss. You are looking for reasons to stay. In both cases, the emotion is running the show, and the emotion is not a reliable investor. The most practical thing I can tell you about developing temperament is this. Build systems, build processes, build written plans that exist before the emotion arrives. Because you cannot will yourself to be calm in a crisis. You cannot discipline your way to rationality in real time. But you can build structures, exit rules, position sizes, written commitments to specific actions that do the rational work for you when your emotional state would otherwise override it. The exit plan is not a constraint on your decision-making. It is a decision you made when you were capable of good decisions, protecting you from the decisions you would make when
when you're not.
I want to give you something concrete before we close. A set of principles that have emerged from everything I have learned about exits, about investing, about the relationship between discipline and wealth. These are not rules in the rigid sense. They are not a formula that produces the same output every time you apply them. They are guidelines, ways of thinking that consistently push decisions in a better direction. The first principle: define your risk before you define your opportunity. Every time I look at a potential investment or trade, my first question is not how much can I make? My first question is how much can I lose? And am I comfortable with that number? This is not pessimism, it is sequencing. Because if you define the upside first, the downside always feels smaller than it is by comparison. You're measuring a potential loss against a potential gain, and the gain makes the loss seem acceptable. But if you define the downside first, if you look directly at the maximum realistic loss, and decide whether that is a number you can absorb without damage, then you're measuring the loss against reality, not against hope. And reality is always a better benchmark. The second principle: the person who knows their downside owns their upside. This sounds paradoxical. It is actually the most practical insight I know. When your downside is defined, when you have a clear, committed exit at a specific loss level, you are free to manage the upside with patience and conviction, because you know the worst case, you've already accepted it. There's nothing more to fear. But when your downside is undefined, when you're holding without a stop, hoping things work out, every move against you ratchets up the anxiety. And anxiety, as we have established, is the enemy of good decision-making. Define the floor, and the ceiling takes care of itself. The third principle: consistency beats perfection. I have never had a perfect exit. Nobody has the person who consistently captures 70% of the right moves while limiting losses on the wrong ones will build more wealth over a career than the person who occasionally captures 100% of a move but takes uncontrolled losses everywhere else. Perfection is what you aim for in theory. Consistency is what actually builds wealth. The fourth principle: your exits reveal your character. This one I have said before, but I want to come back to it at the end, because I think it is the deepest truth I have found in all my years in the market. How you exit, how you behave when a position is going against you, how you behave when a position is going for you, tells you more about your investing character than any analysis you've ever done. If you exit at a loss with discipline, accepting the outcome, logging the lesson, moving on without revenge, you have the character of a long-term investor. If you move stops, hold through losses, and let small mistakes become large ones because you cannot accept being wrong, that character will cost you eventually, no matter how good your analysis is. If you exit at a profit with patience, waiting for your target, resisting the temptation to hold for more, trusting your plan over your impulse, you have the character of someone who will build wealth steadily over time. If you sell too early every time because you're scared, or hold too long every time because you're greedy, neither of those characters will get you where you want to go. The exit is the mirror. It shows you who you are as an investor, and who you are as an investor. Not what you know, not what you can analyze, is what determines your results over time. Let me bring this back to where we started. The trade I held too long. The profit I watched disappear because a voice in my head told me to stay. For years, I told myself that story is a story about a mistake, a bad decision, a moment of weakness. But eventually, I came to see it differently. That trade, and the dozens of similar ones that followed in my early career,
was not a mistake. It was an education. A very expensive education, but an education nonetheless. Because every one of those experiences taught me something about myself that no book, no course, no mentor could have taught me as effectively. They showed me where my ego lived, where my fear lived, where my discipline ended, and my impulse began. And once I saw those things clearly, once I could identify them in myself in real time, while they were happening, I could start to do something about them. Not eliminate them. I want to be honest about that. I still feel the pull to hold when I should exit. I still feel the pull to exit when I should hold. I still hear the voice that says just a little more when a profitable position is approaching my target. Those feelings don't go away. What changes is the relationship between the feeling and the action. The feeling is information, not instruction. The feeling tells me something about what my emotional state is in this moment. And then my plan, the decision I made when I was calm, specific, and rational, tells me what to actually do. The feeling and the action are no longer the same thing. And that separation, small as it sounds, is the entire game. I want to close with the simplest possible version of everything I have said today. Because I believe simplicity, when it is earned, when it is the distillation of real experience rather than the shortcut of someone who hasn't done the work, is more valuable than complexity. Entry gets you into the market. Exit determines everything that happens after. You cannot control what the market does. You cannot control whether a thesis works out, whether the timing is right, whether the macro environment cooperates with your analysis. But you can control when you exit, how you exit, whether your exit serves your capital or your ego. Plan the exit before you enter. Execute the exit without negotiation, and learn from every exit, the good ones and the bad ones, so that each decision makes the next one slightly more disciplined. That is the practice. Not glamorous, not exciting, not the kind of thing that makes for a compelling story at a dinner party, but over years and decades, with the power of compounding working in its quiet, relentless way. That practice is what separates the investors who build lasting wealth from the ones who spend their entire careers starting over. The market will always be here. Opportunities will always come back around. But your capital, once lost to an exit that was too late, too early, or too emotional, cannot be recalled. Protected. Exit when your plan says to exit, and let time do the rest. Thank you for listening. Thank you for listening.